Good morning, I am Taruna Rajora. I welcome you all to my channel Learn Economics in Short. I have prepared lecture series on money and banking and money and financial markets. So in today's lecture, I will introduce the topics to be covered in this series. So we will start with money and its basic function like medium of exchange, unit of account, store of value, standard of deferred payments. Then we will deal with how the money is created by a bank in the system. So basically money creation is the topic. Then we will move to the money supply and its determinants. So we have three types of determinants like Federal Reserve determinants, banking system determinants, public determinants of money supply. Then we move to the types of money like commodity money, full bodied money, fiat money. Then we will discuss the properties of money like physical properties, portability, divisibility, durability. Then we will discuss currency multiplier, deposit multiplier, money multiplier, how these multiplier will affect money supply in the economy. Then we will discuss exogenous money supply, endogenous money supply, and its shift. So, in exogenous money supply, basically, interest rate will not affect the money supply and other factors will affect it. In endogenous, when there is a increase in interest rate, money supply will also increase. So money supply curve is upward sloping. We will discuss this thing in detail when we do this topic. Okay, then we have a transaction cost and financial institutions. Basically, financial institution helps investors to reduce their transaction cost because of their expertise and economies of scale. Then we have a asymmetric information. So now the question is, what is asymmetric information? See, when we have a symmetric information, then buyer and seller have the same information about the product. Okay, asymmetric information means when the buyer and seller don't have the same information about the product. Then moral hazard, adverse selection, these are the problem created by asymmetric information. So adverse selection arises before transaction, moral hazard problem arises after transaction. Okay, then we have a lemon problem in stock and bond markets, principal agent problem, solution to asymmetric information problems, financial crisis, various case study related to financial crisis. So what are the factors responsible for financial crisis? Like there's a high rate of interest, asset market effect, problem in banking system, government fiscal inefficiencies or government fiscal deficits. So basically this will create financial crisis in your economy. Then we move to the next slide. Financial structure, money market. In money market we deal with the short term securities like treasury bills. Okay, then we have a capital market, their instruments. Banks with imperfect information means adverse selection problems in banking system. How do bank deal with these asymmetric information? What are the strategies bank will adopt to deal with this asymmetric information? We will discuss these things in detail in later lectures. Financial sector reforms, financial future markets, contracts, option, term structure of interest rates. These are the three theories which are related to interest rate: expectation hypothesis, segmented market hypothesis, preferred habitat hypothesis. Then we will discuss the Basel norms and its implications on our economy. Monetary policy, what are the targets, what are the instruments? Like open market operation, we will do purchase of securities when we want to increase our money supply, and we will do sale of securities when we want to decrease the money supply. So OMP, basically open market operations, are part of monetary policy. They are instruments of monetary policy. Similarly, cash reserve ratio, which we known as required reserve ratio, repo rate, reverse repo rate, these are the instruments of monetary policy which are used by the central bank of a country. Then we have an intermediate target. Before achieving final targets, we will achieve the intermediate targets. We have a problem in monetary policy making. There's always a problems in monetary policy making. Then we have a drawback of monetary policies like implementation lags, effectiveness lags. Okay, we will discuss this thing in details. Then we have instrument instability, conflicting goals, money targeting, operating procedures. There must be problems in operating procedures. There are challenges of financial liberalization, challenges of transition, fiscal constraints, challenges of liquidity management, monetary policy operations. So when we will end this lecture series, we will discuss the questions and answer sessions. Okay, thank you.